It's not about picking stocks. It's about picking the right portfolio.
Although still inverted, the 10s and 2 spread is up 25 basis points in the last month and up about 50 over the past 3 months. For a fixed income newbie, what, if anything, is this signaling regarding growth and inflation if the long end, which people say is growth expectations, is rising faster than the short, which is inflation expectations?
Well, we wouldn't say, people would say, we would not, we refute what people would say. It sounds like you're new, because that question would have been asked differently if you watched the show from, I think, earlier this week or certainly last week, where I showed you that inflation expectations are currently a 3-factor situation on the big stuff. Growth, yes, is part of it. Inflation is definitely part of it. And the current government shutdown or sovereign credit risk component. So those are the bond yields are going up for all 3 of those reasons, and what percentage of you don't know, and neither do I. On that, what you typically see in terms of inversions or non-inversions or less inversions is not what you see now. We're coming from the most deeply inverted yield curve of the modern era. Okay, so when it goes from minus 120 basis points to minus 70 to minus 50, you're still at minus 50. Historically, the curve being inverted at all is obviously very bearish for something like a regional bank. Okay, so that's how I've stayed with that. I've not, thank God, I've not covered, gone with some narrative on that and covered my KRE short because it's still inverted. And even if it got uninverted, I'd go with the signal on KRE anyway. What you can see is a curve steepening. Why would the curve steepen? You got the short end up here at 5. Right? Let's just do this here so you can see this. As you're entering a recession, what will typically happen is that the curve will steepen. So then you know that we're in a recession because even the Federal Reserve is going to be forced to figure it out. Because what you have part A of this and part B. You have the 2-year yield and you have the 10-year yield. The 2-year yield is at, let's say it's at 5.15%, and this is at what's this, 4.67 right now? So if this starts to go down, because inflation and or growth expectations start to fall and the debt crisis or the shutdown abates a little bit, that's one thing. But if this really starts to go down by like minus 25, minus 50 basis points at a time, the curve's going to steepen, right? The short end goes down faster than the long end comes down. And that's because the Federal Reserve's cutting rates. So you can go back and you can go from inversion, which is a leading indicator for a recession, to a curve that actually steepens during a recession. That's precisely because the Fed is late and panicking and cutting interest rates. And again, if you haven't studied it yet or you hadn't made money in the last 2 recessions like I have, 01 into 1999 coming into 01, or in coming out of 2007, 2008, made money in both. That's what it is. People don't like that because they can't say that. But same thing here. It's leading you into the recession. Curve should steepen when you're actually in it. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.